In the quarter ended June 30th, IMAX grew revenue 12.2% and cut overhead by 2.2%. Those two facts in one sentence are the entire investment case. Net income rose 36.8% on a gross margin above 61%. Here is the quarter. Revenue of $102.8 million, up from $91.7 million. Gross profit of $62.9 million, a margin of 61.2%. And net income of $15.4 million, up from $11.3 million a year ago. But the line that actually matters is the one nobody puts in a headline. Selling, general and administrative expense fell from $35.3 million to $34.5 million, while revenue was growing $11.2 million. Overhead going down while revenue goes up is what operating leverage looks like when it actually shows up instead of being promised. The structural reason is the gross margin. At 61.2%, IMAX's incremental revenue carries very little incremental cost because the expensive parts, the technology and the network, already exist. Earnings grew roughly 3 times faster than revenue. That ratio is the whole model in one number. Two things keep the quarter honest. Restructuring charges were $2.3 million against $800,000 a year ago. So the overhead improvement came alongside real restructuring rather than purely from discipline. And research and development was $1.7 million, which is modest for a company whose moat is supposed to be technical. Seasonality matters here, and it makes annualizing a single quarter misleading. The first quarter produced $81.4 million of revenue and only $4.2 million of net income. First half net income is therefore about $19.6 million, not 4 times the second quarter. IMAX earns disproportionately in quarters with a strong blockbuster slate. The balance sheet is comfortable, but not pristine. Cash of $159.9 million against $243.8 million of convertible notes and other borrowings, so roughly $84 million of net debt. Total assets of $918 million against $467 million of liabilities leaves $356 million of shareholders' equity. So what is it worth? Market value is near $2.16 billion. Add about $84 million of net debt, and the enterprise is around $2.24 billion, or roughly 5.6 times annualized revenue. For a licensing model at 61% gross margins, that is defensible, but it is not cheap, and it is important to be clear what it implies. The market has already priced the operating leverage, which makes the risk the mirror image of a cheap stock. IMAX does not control its own revenue driver. The film slate is decided by studios. It carries China exposure through its majority-owned Shanghai subsidiary and currency exposure across 91 countries. And at 5.6 times sales, a couple of soft quarters compress the valuation faster than they compress the earnings. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.